The annual inflation rate hit 3.5% last month. That's the highest it's been since September. With prices on the rise, it could mean the Federal Reserve will hold off on cutting interest rates. The Dow Jones fell 400 points on Wednesday. Let's bring in Martin Baccardax. He's the senior editor and chief markets correspondent at TheStreet. Oh, Martin, why'd it go up?
That's a great question. John, we saw a massive bet in the bond futures market yesterday, and that usually means that someone is trying to hedge themselves against a surprise. So we were braced for this kind of movement to the upside, but I don't think anybody expected it to be this fast, and I think that's why you see the reaction. If you're digging into the numbers, though, essentially what we're seeing is that the quicker inflation is tied to a stronger economy. There's no question about that. But we are seeing price pressures in things like hospital services, in insurance, and in rents. And those are things that don't necessarily have much of an influence with respect to Fed interest rates. So they could stay hot for a number of months now, and that's sort of what has markets worried right now.
And so that's really interesting. So what do you think this means for the Federal Reserve, particularly if it's items that Federal Reserve policy doesn't maybe necessarily affect directly?
This is where they find themselves, John, and it really is a difficult situation because they had primed the markets for 3 rate cuts this year. And as we sit now, it's very likely that we're going to have the longest gap between the last rate hike and the first rate cut on record. And that's, of course, if we get something in July. It might be September, it might be beyond. So the Fed is going to have to sit tight, preach more patience to an impatient market as it looks to see how some of these influences filter through into the economy. Gratefully, growth is still solid. We're adding jobs, activity is quite strong, and we're seeing a decent amount of consumer spending. But all of that, John, comes with a price. And in this case, it is that faster inflation.
And so everybody's impatient for the rate cuts. Remind us why it's a bad idea or to cut rates too early, or why it could be a bad idea to cut rates too early.
There's no joke, John, that says the Fed tends to go up the escalator when it comes to raising rates and down the elevator when it comes to cutting them. In other words, they like to be in a singular direction, and therefore they are quite careful when they pivot. They don't want to pivot and then have to raise again if it turns out that they were incorrect about inflation. And they've already been caught on the back foot with that transitory debacle from a couple of years ago as we exited the pandemic. So they do want to be absolutely precise as to the timing of the cuts. But as I say, they are having to speak to a market which has been betting on 6 cuts, pared those bets down to 3, and now is likely looking at 2 and maybe even 1. And John, one of them is very likely to come smack in the middle of the presidential campaign in the fall.
Which will have its own, the market will belch a couple of times if that happens. Help us think about the broader economy here, what the Fed's action or lack of action will mean for the broader economy. As you say, the economy is quite strong. So how should we think through this next period now that we have these new numbers? And as you've so clearly laid out, we might not have cuts for a while.
This is just it. I think, John, that you're serving 2 masters at the point if you're the Fed. Firstly, you have to deal with market anticipation and their assumption that a rate cut is going to come in the fall. But at the same time, if a rate cut does come more quickly, that's probably not going to be good news for most Americans because it would suggest that the economy is slowing into the second half of the year. There isn't much signal to that effect at the moment. As you noted, 303,000 new jobs were added to the economy last month. Activity benchmarks are looking strong, and consumers are relatively confident. But if there is a change, and there are some cracks deep underneath that economists are warning about, and we start to get a slowdown into the second half of the year, then the Fed might find itself in a very difficult quandary where inflation is still high, but growth is slowing. And no longer do we have a soft landing, but we have the specter of stagflation, and that's absolutely something no one wants.
Right, exactly the worst of all worlds. Martin Baccardax with TheStreet. Thank you so much.